Let's continue with a different example, project evaluation and beta. Assume that Hyrule Electronics is an all-equity firm producing and marketing video game consoles and software. Hyrule has a beta of 1.35, the market risk premium is 7.2%, and the risk-free rate is 3.5%. There are three projects Hyrule is considering investment. Projects have the same beta as that of the firm. What should the discount rate be for these projects? Also, each project requires an investment of $1 million and lasts for a single year after the initial investment of this $1 million. Project A's expected cash flows next year is $1.5 million, B's $1.25 million, and C's $1.05 million. Calculate each project's IRR, internal rate of return, and NVP, net present value. And which project should Hyrule invest, considering that each project is independent? Plot the security market plan (SML). Label the regions within which you should accept or reject a project. Also show each project on that plot. So let's look at the solution. Projects have the same beta or risk as that of the firm, and Hyrule, the firm, is an all-equity firm. So the cost of equity capital of the firm should be the discount rate of the projects, or alternatively, the expected return on Hyrule stock should be equal to the required return on that stock, which is the same as the discount rate of the cash flows of the firm, including cash flows of these projects. Let us use CAPM to calculate the expected return on Hyrule stock. Risk-free rate, remember 3.5% plus beta 3.25 multiplied by the equity risk premium, which was given as 7.2%. So this equation should be equal to 13.22, 0.1322 or 13.22%. This is the discount rate for all the projects, or the expected return on these projects, and net present value will be calculated through the use of this discount rate. And for IRR, we use this discount rate to accept or reject projects. So project A, IRR should be, remember, IRR is a discount rate that will render these future cash flows zero. And then we will use this IRR and compare it with the discount rate of the projects, and we'll decide on whether we should invest in this project or we should reject the project. So 0 equal to initial investment of $1 million plus the cash flows for the next year, $1.5 million discounted for a single year, 1 plus IRR. So if you solve IRR A, or internal rate of return for this specific project A, should be equal to 50%. And net present value for this project A will be initial investment minus again plus next year's future cash flows discounted for a single year and discounted at the cost of equity capital, which is 13.22. So we will be having this $324,854.266. So accept this project given the positive net present value and IRR rule. Based on IRR rule, this is an investing project. There is an initial investment, cash outflows, then we will be getting cash inflows. This is investing type of a project, and for investing type projects, actually, if the discount rate 13.22 is less than the IRR 50%, you should accept this project. Remember, for the investing type of projects, for the IRR rule, IRR is 50%. If, for example, if you plug 0 in here, net present value will be positive. So 0 is less than 50%. So you should accept projects if the discount rate is less than the internal rate of return of the project. But for example, if you enter too much of a big value, for example, something like infinity, so this term will be equal to 0 and the net present value will be equal to, it will be a negative number. So that's why for discount rates higher than the internal rate of return, you should reject the project. Remember, this is the essence of the internal rate of return rule. So for the project B, we should follow the same drill. 0 should be equal to initial investment plus next year's cash flows discounted for a single year by the IRR, because remember, IRR is the discount rate that will render these cash flows 0. So IRR will be equal to 25%, and net present value for the project B will be initial investment, cash outflows plus the next year's cash flows discounted at the cost of equity capital for a single year. So again, this is a positive value. So you should accept this project doing the positive net present value and the IRR rule because it's an investing type of project. Discount rate 13.22 is less than the IRR. So based on the IRR rule, you should also accept the project. For the project C, again, we will be following the same drill. So the equation should be equal to 0 at this discount rate, which is IRR. IRR is the discount rate. Again, I am underscoring this point. IRR is a discount rate that will render these cash flows 0. So 0 should be equal to initial cash outflow plus next year's cash inflows discounted at the IRR for a single year. So IRR should be equal to 5%. And net present value for the project C will be initial investment cash outflow plus next year's future cash flows discounted for a single year at the cost of equity capital. This is a negative number, so reject this project given the negative net present value and IRR rule, because again, this is an investing project. Cash outflows will be followed by cash inflows. That's why it's an investing project. And R, discount rate 13.22 is greater than the internal rate of return 5% for an investing type of project. That's why based on the IRR rule, we should also reject the project. So solution continues. Recall that all projects are assumed to have the same risk as the firm as a whole. Because the cost of equity capital is 13.22%, projects in an all equity firm are discounted at this rate. Remember, for projects A, B, and C, the same beta as that of the firm, and we also calculate the IRR 50%, 25%, and 5%. So then on Excel, I calculated using CAPM the expected return on the security at different beta values. Remember, risk-free rate is fixed, market risk premium is fixed. The expected return on the security will be dependent on changing beta values. Again, the equation will be that of the CAPM. So then I created the plot. So using SML security market line to estimate the risk-adjusted discount rate for risky projects. Remember, the x-axis, the horizontal axis will be firm's risk beta, and the vertical axis will be project's internal rate of return. So based on this, we created this plot. This is the equation of the line. R square, of course, should be equal to 1 because it is perfectly linear. And remember, based on this equation of the line, intercept will be the risk-free rate, 3.5%, and the slope here, the term before x, is the slope. This is the equity risk premium, and it was 7.2%. So then we created the security market line. This will be the security market line. And project A, project B, and project C, I also created the points for all these projects. Remember, the first term will be the beta, and the second term will be the project's internal rate of return. So this will be the region above the security market line will be the accept region, because here the net present values will be positive and internal rate of returns will be greater than the discount rate or the cost of equity capital of the firm for an investing type of a project. So this will be the accept region, and this will be the reject region, because below the security market line we have projects for which net present values are negative or less than 0, or IRR, internal rate of returns, are less than the discount rate or the cost of equity capital of the firm for an investing type of projects. And so this is the reject region. You should reject all the projects that will lie below the security market line. So the diagonal line here, the blue line called the security market line, SML. Remember, we covered this in the previous session as well. Is a graphical depiction of the CAPM and represents the relationship between the cost of equity capital and the firm's beta. And all equity firms should accept a project whose internal rate of return is greater than the cost of equity capital. Remember, cost of equity capital will be the discount rate or the required return on these projects, and should reject a project whose internal rate of return, IRR, is less than the cost of equity capital. This graph assumes that all projects are as risky as the firm.